Roman 20. I myself never spoke to any of the great stock manipulators that the street still talks about. I don't mean leaders, I mean manipulators. They were all before my time. Although when I first came to New York, James R. Keene, greatest of them all, was in his prime. But I was a mere youngster then, exclusively concerned with duplicating, in a reputable broker's office, the success I had enjoyed in the bucket shops of my native city. And then, too, at the time Keene was busy with the U.S. Steel stocks, his manipulative masterpiece, I had no experience with manipulation, no real knowledge of it or of its value or meaning, and, for that matter, no great need of such knowledge. If I thought about it at all, I suppose I must have regarded it as a well-dressed form of thimble rigging, of which the lowbrow form was such tricks as had been tried on me in the bucket shops. Such talk as I since have heard on the subject has consisted in great part of surmises and suspicions, of guesses rather than intelligent analyses. More than one man who knew him well has told me that Keene was the boldest and most brilliant operator that ever worked in Wall Street. That is saying a great deal, for there have been some great traders. Their names are now all but forgotten, but nevertheless they were kings in their day for a day. They were pulled up out of obscurity into the sunlight of financial fame by the ticker tape, and the little paper ribbon didn't prove strong enough to keep them suspended there long enough for them to become historical fixtures. At all events, Keene was by all odds the best manipulator of his day, and it was a long and exciting day. He capitalized his knowledge of the game, his experience as an operator, and his talents when he sold his services to the Havemere brothers, who wanted him to develop a market for the sugar stocks. He was broke at the time, or he would have continued to trade on his own hook, and he was some plunger. He was successful with sugar, made the shares trading favorites, and that made them easily vendable. After that, he was asked time and again to take charge of pools. I am told that in these pool operations, he never asked nor accepted a fee, but paid for his share like the other members of the pool. The market conduct of the stock, of course, was exclusively in his charge. Often there was talk of treachery on both sides. His feud with the Whitney Ryan clique arose from such accusations. It is not difficult for a manipulator to be misunderstood by his associates. They don't see his needs as he himself does. I know this from my own experience. It is a matter of regret that Keene did not leave an accurate record of his greatest exploit, the successful manipulation of the U.S. Steel shares in the spring of 1901. As I understand it, Keene never had an interview with J.P. Morgan about it. Morgan's firm dealt with or through Talbot J. Taylor & Co., at whose office Keene made his headquarters. Talbot Taylor was Keene's son-in-law. I am assured that Keene's fee for his work consisted of the pleasure he derived from the work. That he made millions trading in the market, he helped to put up that spring, is well known. He told a friend of mine that in the course of a few weeks, he sold in the open market for the underwriters, syndicate, more than 750,000 shares. Not bad when you consider two things: that they were new and untried stocks of a corporation whose capitalization was greater than the entire debt of the United States at that time, and second, that men like D.G. Reed, W.B. Leeds, the Moore brothers, Henry Phipps, H.C. Frick, and the other steel magnates also sold hundreds of thousands of shares to the public at the same time in the same market that Keene helped to create. Of course, general conditions favored him. Not only actual business, but sentiment and his unlimited financial backing made possible his success. What we had was not merely a big bull market, but a boom and a state of mind not likely to be seen again. The undigested securities panic came later, when Steel Common, which Keene had marked up to 55 in 1901, sold at 10 in 1903 and at 8 in 1904. We can't analyze Keene's manipulative campaigns. His books are not available. The adequately detailed record is non-existent. For example, it would be interesting to see how he worked in amalgamated copper. H.H. Rogers and William Rockefeller had tried to dispose of their surplus stock in the market and had failed. Finally, they asked Keene to market their line, and he agreed. Bear in mind that H.H. Rogers was one of the ablest businessmen of his day in Wall Street, and that William Rockefeller was the boldest speculator of the entire Standard Oil coterie. They had practically unlimited resources and vast prestige, as well as years of experience in the stock market game, and yet they had to go to Keene. I mention this to show you that there are some tasks which it requires a specialist to perform. Here was a widely touted stock, sponsored by America's greatest capitalists, that could not be sold except at a great sacrifice of money and prestige. Rogers and Rockefeller were intelligent enough to decide that Keene alone might help them. Keene began to work at once. He had a bull market to work in and sold 220,000 shares of Amalgamated at around par. After he disposed of the insider's line, the public kept on buying, and the price went 10 points higher. Indeed, the insiders got bullish on the stock they had sold when they saw how eagerly the public was taking it. There was a story that Rogers actually advised Keene to go long of Amalgamated. It is scarcely credible that Rogers meant to unload on Keene. He was too shrewd a man not to know that Keene was no bleeding lamb. Keene worked as he always did, that is, doing his big selling on the way down after the big rise. Of course, his tactical moves were directed by his needs and by the minor currents that changed from day to day. In the stock market, as in warfare, it is well to keep in mind the difference between strategy and tactics. One of Keene's confidential men, he is the best fly fisherman I know, told me only the other day that during the Amalgamated campaign Keene would find himself almost out of stock one day, that is, out of the stock he had been forced to take in marking up the price, and on the next day he would buy back thousands of shares. On the day after that, he would sell on balance. Then he would leave the market absolutely alone to see how it would take care of itself and also to accustom it to do so. When it came to the actual marketing of the line, he did what I told you. He sold it on the way down. The trading public is always looking for a rally, and besides, there is the covering by the shorts. The man who was closest to Keene during that deal told me that after Keene sold the Rogers-Rockefeller line for something like $20 or $25 million in cash, Rogers sent him a check for $200,000. This reminds you of the millionaire's wife who gave the Metropolitan Opera House scrubwoman 50 cents reward for finding the $100,000 pearl necklace. Keene sent the check back with a polite note saying he was not a stockbroker and that he was glad to have been of some service to them. They kept the check and wrote him that they would be glad to work with him again. Shortly after that, it was that Rogers gave Keene the friendly tip to buy Amalgamated at around 130. A brilliant operator, James R. Keene. His private secretary told me that when the market was going his way, Mr. Keene was irascible, and those who knew him say his irascibility was expressed in sardonic phrases that lingered long in the memory of his hearers. But when he was losing, he was in the best of humor, a polished man of the world, agreeable, epigrammatic, interesting. He had in superlative degree the qualities of mind that are associated with successful speculators anywhere. That he did not argue with the tape is plain. He was utterly fearless but never reckless. He could and did turn in a twinkling if he found he was wrong. Since his day, there have been so many changes in stock exchange rules and so much more rigorous enforcement of old rules, so many new taxes on stock sales and profits, and so on, that the game seems different. Devices that Keene could use with skill and profit can no longer be utilized. Also, we are assured, the business morality of Wall Street is on a higher plane. Nevertheless, it is fair to say that in any period of our financial history, Keene would have been a great manipulator because he was a great stock operator and knew the game of speculation from the ground up. He achieved what he did because conditions at the time permitted him to do so. He would have been as successful in his undertakings in 1922 as he was in 1901 or in 1876, when he first came to New York from California and made $9 million in 2 years. There are men whose gait is far quicker than the mob's. They are bound to lead no matter how much the mob changes. As a matter of fact, the change is by no means as radical as you'd imagine. The rewards are not so great, for it is no longer pioneer work, and therefore it is not pioneer's pay. But in certain respects, manipulation is easier than it was, in other ways much harder than in Keene's day. There is no question that advertising is an art, and manipulation is the art of advertising through the medium of the tape. The tape should tell the story the manipulator wishes its readers to see. The truer the story, the more convincing it is bound to be, and the more convincing it is, the better the advertising is. A manipulator today, for instance, has not only to make a stock look strong, but also to make it be strong. Manipulation, therefore, must be based on sound trading principles. That is what made Keene such a marvelous manipulator. He was a consummate trader to begin with. The word manipulation has come to have an ugly sound. It needs an alias. I do not think there is anything so very mysterious or crooked about the process itself when it has for an object the selling of a stock in bulk, provided, of course, that such operations are not accompanied by misrepresentation. There is little question that a manipulator necessarily seeks his buyers among speculators. He turns to men who are looking for big returns on their capital and are therefore willing to run a greater than normal business risk. I can't have much sympathy for the man who, knowing this, nevertheless blames others for his own failure to make easy money. He is a devil of a clever fellow when he wins. But when he loses money, the other fellow was a crook, a manipulator. In such moments, and from such lips, the word connotes the use of marked cards. But this is not so. Usually the object of manipulation is to develop marketability, that is, the ability to dispose of fair-sized blocks at some price at any time. Of course, a pool, by reason of a reversal of general market conditions, may find itself unable to sell except at a sacrifice too great to be pleasing. They then may decide to employ a professional, believing that his skill and experience will enable him to conduct an orderly retreat instead of suffering an appalling rout. You will notice that I do not speak of manipulation designed to permit considerable accumulation of a stock as cheaply as possible, as, for instance, in buying for control, because this does not happen often nowadays. When Jay Gould wished to cinch his control of Western Union and decided to buy a big block of the stock, Washington E. Connor, who had not been seen on the floor of the stock exchange for years, suddenly showed up in person at the Western Union Post. He began to bid for Western Union. The traders to a man laughed at his stupidity in thinking them so simple, and they cheerfully sold him all the stock he wanted to buy. It was too raw a trick to think he could put up the price by acting as though Mr. Good wanted to buy Western Union. Was that manipulation? I think I can only answer that by saying no and yes. In the majority of cases, the object of manipulation is, as I said, to sell stock to the public at the best possible price. It is not alone a question of selling, but of distributing. It is obviously better in every way for a stock to be held by 1,000 people than by one man, better for the market in it. So it is not alone the sale at a good price, but the character of the distribution that a manipulator must consider. There is no sense in marking up the price to a very high level if you cannot induce the public to take it off your hands later. Whenever inexperienced manipulators try to unload at the top and fail, old-timers look mighty wise and tell you that you can lead a horse to water, but you cannot make him drink. Original devils. As a matter of fact, it is well to remember a rule of manipulation, a rule that Keene and his able predecessors well knew. It is this: stocks are manipulated to the highest point possible and then sold to the public on the way down. Let me begin at the beginning. Assume that there is some one-in underwriting syndicate or a pool or an individual that has a block of stock which it is desired to sell at the best price possible. It is a stock duly listed on the New York Stock Exchange. The best place for selling it ought to be the open market, and the best buyer ought to be the general public. The negotiations for the sale are in charge of a man. Here some present or former associate has tried to sell the stock on the stock exchange and has not succeeded. He is or soon become sufficiently familiar with stock market operations to realize that more experience and greater aptitude for the work are needed than he possesses. He knows personally, or by hearsay, several men who have been successful in their handling of similar deals, and he decides to avail himself of their professional skill. He seeks one of them as he would seek a physician if he were ill, or an engineer, if he needed that kind of expert. Suppose he has heard of me as a man who knows the game. Well, I take it that he tries to find out all he can about me. He then arranges for an interview and in due time calls at my office. Of course, the chances are that I know about the stock and what it represents. It is my business to know. That is how I make my living. My visitor tells me what he and his associates wish to do and asks me to undertake the deal. It is then my turn to talk. I ask for whatever information I deem necessary to give me a clear understanding of what I am asked to undertake. I determine the value and estimate the market possibilities of that stock. That and my reading of current conditions in turn help me to gauge the likelihood of success for the proposed operation. If my information inclines me to a favorable view, I accept the proposition and tell him then and there what my terms will be for my services. If he in turn accepts my terms the honorarium and the conditions, I begin my work at once. I generally ask and receive calls on a block of stock. I insist upon graduated calls as the fairest to all concerned. The price of the call begins at a little below the prevailing market price and goes up. Say, for example, that I get calls on 100,000 shares and the stock is quoted at 40. I begin with a call for some thousands of shares at 35, another at 37, another at 40, and at 45 and 50, and so on up to 75 or 80. If as the result of my professional work my manipulation the price goes up, and if at the highest level there is a good demand for the stock so that I can sell fair-sized blocks of it, I of course call the stock. I am making money, but so are my clients making money. This is as it should be. If my skill is what they are paying for, they ought to get value. Of course, there are times when a pool may be wound up at a loss, but that is seldom, for I do not undertake the work unless I see my way clear to a profit. This year I was not so fortunate in one or two deals, and I did not make a profit. There are reasons, but that is another story, to be told later perhaps. The first step in a bull movement in a stock is to advertise the fact that there is a bull movement on. Sounds silly, doesn't it? Well, think a moment. It isn't as silly as it sounded, is it? The most effective way to advertise what, in effect, are your honorable intentions is to make the stock active and strong. After all is said and done, the greatest publicity agent in the wide world is the ticker, and by far the best advertising medium is the tape. I do not need to put out any literature for my clients. I do not have to inform the daily press as to the value of the stock or to work the financial reviews for notices about the company's prospects. Neither do I have to get a following. I accomplish all these highly desirable things by merely making the stock active. When there is activity, there is a synchronous demand for explanations, and that means, of course, that the necessary reasons for publication supply themselves without the slightest aid from me. Activity is all that the floor traders ask. They will buy or sell any stock at any level if only there is a free market for it. They will deal in thousands of shares wherever they see activity, and their aggregate capacity is considerable. It necessarily happens that they constitute the manipulator's first crop of buyers. They will follow you all the way up, and they thus are a great help at all the stages of the operation. I understand that James R. Keene used habitually to employ the most active of the room traders, both to conceal the source of the manipulation, and also because he knew that they were by far the best business spreaders and tip distributors. He often gave calls to them, verbal calls above the market, so that they might do some helpful work before they could cash in. He made them earn their profit. To get a professional following, I myself have never had to do more than to make a stock active. Traders don't ask for more. It is well, of course, to remember that these professionals on the floor of the exchange buy stocks with the intention of selling them at a profit. They do not insist on its being a big profit, but it must be a quick profit. I make the stock active in order to draw the attention of speculators to it, for the reasons I have given. I buy it and I sell it, and the traders follow suit. The selling pressure is not apt to be strong where a man has as much speculatively held stock sewed up in calls as I insist on having. The buying, therefore, prevails over the selling, and the public follows the lead not so much of the manipulator as of the room traders. It comes in as a buyer. This highly desirable demand I fill, that is, I sell stock on balance. If the demand is what it ought to be, it will absorb more than the amount of stock I was compelled to accumulate in the earlier stages of the manipulation. And when this happens, I sell the stock short, that is, technically. In other words, I sell more stock than I actually hold. It is perfectly safe for me to do so since I am really selling against my calls. Of course, when the demand from the public slackens, the stock ceases to advance. Then I wait. Say then that the stock has ceased to advance. There comes a weak day. The entire market may develop a reactionary tendency, or some sharp-eyed trader may perceive that there are no buying orders to speak of in my stock, and he sells it, and his fellows follow. Whatever the reason may be, my stock starts to go down. Well, I begin to buy it. I give it the support that a stock ought to have if it is in good odor with its own sponsors. And more, I am able to support it without accumulating it, that is, without increasing the amount I shall have to sell later on. Observe that I do this without decreasing my financial resources. Of course, what I am really doing is covering stock I sold short at higher prices when the demand from the public or from the traders or from both enabled me to do it. It is always well to make it plain to the traders and to the public, also that there is a demand for the stock on the way down. That tends to check both reckless short selling by the professionals and liquidation by frightened holders, which is the selling you usually see when a stock gets weaker and weaker, which in turn is what a stock does when it is not supported. These covering purchases of mine constitute what I call the stabilizing process. As the market broadens, I of course sell stock on the way up, but never enough to check the rise. This is in strict accordance with my stabilizing plans. It is obvious that the more stock I sell on a reasonable and orderly advance, the more I encourage the conservative speculators, who are more numerous than the reckless room traders, and in addition, the more support I shall be able to give to the stock on the inevitable weak days. By always being short, I always am in a position to support the stock without danger to myself. As a rule, I begin my selling at a price that will show me a profit. But I often sell without having a profit, simply to create or to increase what I may call my riskless buying power. My business is not alone to put up the price or to sell a big block of stock for a client, but to make money for myself. That is why I do not ask my clients to finance my operations. My fee is contingent upon my success. Of course, what I have described is not my invariable practice. I neither have nor adhere to an inflexible system. I modify my terms and conditions according to circumstances. A stock which it is desired to distribute should be manipulated to the highest possible point and then sold. I repeat this both because it is fundamental and because the public apparently believes that the selling is all done at the top. Sometimes a stock gets waterlogged, as it were. It doesn't go up. That is the time to sell. The price naturally will go down on your selling rather further than you wish, but you can generally nurse it back. As long as a stock that I am manipulating goes up on my buying, I know I am hunky, and if need be, I buy it with confidence and use my own money without fear, precisely as I would any other stock that acts the same way. It is the line of least resistance. You remember my trading theories about that line, don't you? Well, when the price line of least resistance is established, I follow it, not because I am manipulating that particular stock at that particular moment, but because I am a stock operator at all times. When my buying does not put the stock up, I stop buying and then proceed to sell it down. And that also is exactly what I would do with that same stock if I did not happen to be manipulating it. The principal marketing of the stock, as you know, is done on the way down. It is perfectly astonishing how much stock a man can get rid of on a decline. I repeat that at no time during the manipulation do I forget to be a stock trader. My problems as a manipulator, after all, are the same that confront me as an operator. All manipulation comes to an end when the manipulator cannot make a stock do what he wants it to do. When the stock you are manipulating doesn't act as it should, quit. Don't argue with the tape. Do not seek to lure the profit back. Quit while the quitting is good and cheap. Roman 21. I am well aware that all these generalities do not sound especially impressive. Generalities seldom do. Possibly I may succeed better if I give a concrete example. I'll tell you how I marked up the price of a stock 30 points, and in so doing accumulated only 7,000 shares and developed a market that would absorb almost any amount of stock. It was Imperial Steel. The stock had been brought out by reputable people, and it had been fairly well tipped as a property of value. About 30% of the capital stock was placed with the general public through various Wall Street houses, but there had been no significant activity in the shares after they were listed. From time to time, somebody would ask about it, and one or another insider members of the original underwriting syndicate would say that the company's earnings were better than expected and the prospects more than encouraging. This was true enough and very good as far as it went, but not exactly thrilling. The speculative appeal was absent, and from the investor's point of view, the price stability and dividend permanency of the stock were not yet demonstrated. It was a stock that never behaved sensationally. It was so gentlemanly that no corroborative rise ever followed the insiders' eminently truthful reports. On the other hand, neither did the price decline. Imperial Steel remained unhonored and unsung and untipped, content to be one of those stocks that don't go down because nobody sells, and that nobody sells because nobody likes to go short of a stock that is not well distributed. The seller is too much at the mercy of the loaded-up inside clique. Similarly, there is no inducement to buy such a stock. To the investor, Imperial Steel therefore remained a speculation. To the speculator, it was a dead one, the kind that makes an investor of you against your will by the simple expedient of falling into a trance the moment you go long of it. The chap who is compelled to lug a corpse a year or two always loses more than the original cost of the deceased. He is sure to find himself tied up with it when some really good things come his way. One day, the foremost member of the Imperial Steel Syndicate, acting for himself and associates, came to see me. They wished to create a market for the stock, of which they controlled the undistributed 70%. They wanted me to dispose of their holdings at better prices than they thought they would obtain if they tried to sell in the open market. They wanted to know on what terms I would undertake the job. I told him that I would let him know in a few days. Then I looked into the property. I had experts go over the various departments of the company: industrial, commercial, and financial. They made reports to me which were unbiased. I wasn't looking for the good or the bad points, but for the facts, such as they were. The reports showed that it was a valuable property. The prospects justified purchases of the stock at the prevailing market price if the investor were willing to wait a little. Under the circumstances, an advance in the price would in reality be the commonest and most legitimate of all market movements, to wit, the process of discounting the future. There was therefore no reason that I could see why I should not conscientiously and confidently undertake the bull manipulation of Imperial Steel. I let my man know my mind, and he called at my office to talk the deal over in detail. I told him what my terms were. For my services, I asked no cash, but calls on 100,000 shares of the Imperial Steel stock. The price of the calls ran up from 70 to 100. That may seem like a big fee to some, but they should consider that the insiders were certain they themselves could not sell 100,000 shares or even 50,000 shares at 70. There was no market for the stock. All the talk about wonderful earnings and excellent prospects had not brought in buyers, not to any great extent. In addition, I could not get my fee in cash without my clients first making some millions of dollars. What I stood to make was not an exorbitant selling commission. It was a fair contingent fee. Knowing that the stock had real value and that general market conditions were bullish and therefore favorable for an advance in all good stocks, I figured that I ought to do pretty well. My clients were encouraged by the opinions I expressed, agreed to my terms at once, and the deal began with pleasant feelings all around. I proceeded to protect myself as thoroughly as I could. The syndicate owned or controlled about 70% of the outstanding stock. Had them deposit their 70% under a trust agreement. I didn't propose to be used as a dumping ground for the big holders. With the majority holdings thus securely tied up, I still had 30% of scattered holdings to consider, but that was a risk I had to take. Experienced speculators do not expect ever to engage in utterly riskless ventures. As a matter of fact, it was not much more likely that all the untrusted stock would be thrown on the market at one fell swoop than that all the policyholders of a life insurance company would die at the same hour, the same day. There are unprinted actuarial tables of stock market risks as well as of human mortality. Having protected myself from some of the avoidable dangers of a stock market deal of that sort, I was ready to begin my campaign. Its objective was to make my calls valuable. To do this, I must put up the price and develop a market in which I could sell 100,000 shares the stock in which I held options. The first thing I did was to find out how much stock was likely to come on the market on an advance. This was easily done through my brokers, who had no trouble in ascertaining what stock was for sale at or a little above the market. I don't know whether the specialists told them what orders they had on their books or not. The price was nominally 70, but I could not have sold 1,000 shares at that price. I had no evidence of even a moderate demand at that figure or even a few points lower. I had to go by what my brokers found out, but it was enough to show me how much stock there was for sale and how little was wanted. As soon as I had a line on these points, I quietly took all the stock that was for sale at 70 and higher. When I say I, you will understand that I mean my brokers. The sales were for account of some of the minority holders because my clients naturally had canceled whatever selling orders they might have given out before they tied up their stock. I didn't have to buy very much stock. Moreover, I knew that the right kind of advance would bring in other buying orders and, of course, selling orders also. I didn't give bull tips on Imperial Steel to anybody. I didn't have to. My job was to seek directly to influence sentiment by the best possible kind of publicity. I do not say that there should never be bull propaganda. It is as legitimate and indeed as desirable to advertise the value of a new stock as to advertise the value of woolens or shoes or automobiles. Accurate and reliable information should be given by the public. But what I meant was that the tape did all that was needed for my purpose. As I said before, the reputable newspapers always try to print explanations for market movements. It is news. Their readers demand to know not only what happens in the stock market, but why it happens. Therefore, without the manipulator lifting a finger, the financial writers will print all the available information and gossip, and also analyze the reports of earnings, trade condition, and outlook. In short, whatever may throw light on the advance. Whenever a newspaperman or an acquaintance asks my opinion of a stock, and I have one, I do not hesitate to express it. I do not volunteer advice and I never give tips, but I have nothing to gain in my operations from secrecy. At the same time, I realize that the best of all teepsters, the most persuasive of all salesmen, is the tape. When I had absorbed all the stock that was for sale at 70, and a little higher, I relieved the market of that pressure. And naturally, that made clear for trading purposes the line of least resistance in Imperial Steel. It was manifestly upward. The moment that fact was perceived by the observant traders on the floor, they logically assumed that the stock was in for an advance the extent of which they could not know. But they knew enough to begin buying. Their demand for Imperial Steel, created exclusively by the obviousness of the stock's rising tendency, the tape's infallible bull tip, I promptly filled. I sold to the traders the stock that I had bought from the tired-out holders at the beginning. Of course, this selling was judiciously done. I contented myself with supplying the demand. I was not forcing my stock on the market, and I did not want too rapid an advance. It wouldn't have been good business to sell out the half of my 100,000 shares at that stage of the proceedings. My job was to make a market on which I might sell my entire line. But even though I sold only as much as the traders were anxious to buy, the market was temporarily deprived of my own buying power, which I had hitherto exerted steadily. In due course, the traders' purchases ceased, and the price stopped rising. As soon as that happened, there began the selling by disappointed bulls or by those traders whose reasons for buying disappeared the instant the rising tendency was checked. But I was ready for this selling, and on the way down I bought back the stock I had sold to the traders a couple of points higher. This buying of stock I knew was bound to be sold in turn checked the downward course, and when the price stopped going down, the selling orders stopped coming in. I then began all over again. I took all the stock that was for sale on the way up. It wasn't very much, and the price began to rise a second time, from a higher starting point than 70. Don't forget that on the way down there are many holders who wish to heaven they had sold theirs, but won't do it 3 or 4 points from the top. Such speculators always vow they will surely sell out if there is a rally. They put in their orders to sell on the way up, and then they change their minds with the change in the stock's price trend. Of course, there is always profit taking from safe-playing quick runners, to whom a profit is always a profit to be taken. All I had to do after that was to repeat the process, alternately buying and selling, but always working higher. Sometimes, after you have taken all the stock that is for sale, it pays to rush up the price sharply, to have what might be called little bull flurries in the stock you are manipulating. It is excellent advertising, because it makes talk and also brings in both the professional traders and that portion of the speculating public that likes action. It is, I think, a large portion. I did that in Imperial Steel, and whatever demand was created by those spurts I supplied. My selling always kept the upward movement within bounds both as to extent and as to speed. In buying on the way down and selling on the way up, I was doing more than marking up the price. I was developing the marketability of Imperial Steel. After I began my operations in it, there never was a time when a man could not buy or sell the stock freely. I mean by this, buy or sell a reasonable amount without causing over-violent fluctuations in the price. The fear of being left high and dry if he bought, or squeezed to death if he sold, was gone. The gradual spread among the professionals and the public of a belief in the permanence of the market for imperial steel had much to do with creating confidence in the movement. And of course, the activity also put an end to a lot of other objections. The result was that after buying and selling a good many thousands of shares, I succeeded in making the stock sell at par. At $100 a share, everybody wanted to buy imperial steel. Why not? Everybody now knew that it was a good stock, that it had been and still was a bargain. The proof was the rise. A stock that could go 30 points from 70 could go up 30 more from par. That is the way a good many argued. In the course of marking up the price, those 30 points, I accumulated only 7,000 shares. The price on this line averaged me almost exactly 85. That meant a profit of 15 points on it, but of course, my entire profit, still on paper, was much more. It was a safe enough profit, for I had a market for all I wanted to sell. The stock would sell higher on judicious manipulation, and I had graduated calls on 100,000 shares beginning at 70 and ending at 100. Circumstances prevented me from carrying out certain plans of mine for converting my paper profits into good hard cash. It had been, if I do say so myself, a beautiful piece of manipulation, strictly legitimate and deservedly successful. The property of the company was valuable, and the stock was not dear at the higher price. One of the members of the original syndicate developed a desire to secure the control of the property of a prominent banking house with ample resources. The control of a prosperous and growing concern like the Imperial Steel Corporation is possibly more valuable to a banking firm than to individual investors. At all events, this firm made me an offer for all my options on the stock. It meant an enormous profit for me, and I instantly took it. I am always willing to sell out when I can do so in a lump at a good profit. I was quite content with what I made out of it. Before I disposed of my calls on the 100,000 shares, I learned that these bankers had employed more experts to make a still more thorough examination of the property. Their reports showed enough to bring me in the offer I got. I kept several thousand shares of the stock for investment. I believe in it. There wasn't anything about my manipulation of imperial steel that wasn't normal and sound. As long as the price went up on my buying, I knew I was okay. The stock never got waterlogged, as a stock sometimes does. When you find that it fails to respond adequately to your buying, you don't need any better tip to sell. You know that if there is any value to a stock and general market conditions are right, you can always nurse it back after a decline, no matter if it's 20 points. But I never had to do anything like that in imperial steel. In my manipulation of stocks, I never lose sight of basic trading principles. Perhaps you wonder why I repeat this, or why I keep on harping on the fact that I never argue with the tape or lose my temper at the market because of its behavior. You would think, wouldn't you, that shrewd men who have made millions in their own business, and in addition, have successfully operated in Wall Street at times, would realize the wisdom of playing the game dispassionately. Well, you would be surprised at the frequency with which some of our most successful promoters behave like peevish women, because the market does not act the way they wish it to act. They seem to take it as a personal slight, and they proceed to lose money by first losing their temper. There has been much gossip about a disagreement between John Prentice and myself. People have been led to expect a dramatic narrative of a stock market deal that went wrong, or some double-crossing that cost me or him millions, or something of that sort. Well, it was. Prentice and I had been friendly for years. He had given me at various times information that I was able to utilize profitably, and I had given him advice which he may or may not have followed. If he did, he saved money. He was largely instrumental in the organization and promotion of the Petroleum Products Company. After a more or less successful market debut, general conditions changed for the worse, and the new stock did not fare as well as Prentice and his associates had hoped. When basic conditions took a turn for the better, Prentice formed a pool and began operations in peat products. I cannot tell you anything about his technique. He didn't tell me how he worked, and I didn't ask him. But it was plain that, notwithstanding his Wall Street experience and his undoubted cleverness, Whatever it was, he did proved of little value, and it didn't take the pool long to find out that they couldn't get rid of much stock. He must have tried everything he knew, because a pool manager does not ask to be superseded by an outsider unless he feels unequal to the task, and that is the last thing the average man likes to admit. At all events, he came to me, and after some friendly preliminaries, he said he wanted me to take charge of the market for peat products and dispose of the pool's holdings, which amounted to a little over 100,000 shares. The stock was selling at 102 to 103. The thing looked dubious to me, and I declined his proposition with thanks. But he insisted that I accept. He put it on personal grounds, so that in the end, I consented. I constitutionally dislike to identify myself with enterprises in the success of which I cannot feel confidence, but I also think a man owes something to his friends and acquaintances. I said I would do my best, but I told him I did not feel very cocky about it, and I enumerated the adverse factors that I would have to contend with. But all Prentice said to that was that he wasn't asking me to guarantee millions in profits to the pool. He was sure that if I took hold, I'd make out well enough to satisfy any reasonable being. Well, there I was, engaged in doing something against my own judgment. I found, as I feared, a pretty tough state of affairs, due in great measure to Prentice's own mistakes while he was manipulating the stock for account of the pool. But the chief factor against me was time. I was convinced that we were rapidly approaching the end of a bull swing, and therefore that the improvement in the market, which had so encouraged Prentice, would prove to be merely a short-lived rally. I feared that the market would turn definitely bearish before I could accomplish much with peat products. However, I had given my promise, and I decided to work as hard as I knew how. I started to put up the price. I had moderate success. I think I ran it up to 107 or thereabouts, which was pretty fair, and I was even able to sell a little stock on balance. It wasn't much, but I was glad not to have increased the pool's holdings. There were a lot of people not in the pool who were just waiting for a small rise to dump their stock, and I was a godsend to them. Had general conditions been better, I also would have done better. It was too bad that I wasn't called in earlier. All I could do now, I felt, was to get out with as little loss as possible to the pool. I sent for Prentice and told him my views, but he started to object. I then explained to him why I took the position I did. I said, "Prentice, I can feel very plainly the pulse of the market. There is no follow-up in your stock. It is no trick to see just what the public's reaction is to my manipulation. Listen, when peat products is made as attractive to traders as possible, and you give it all the support needed at all times, and notwithstanding all that you find that the public leaves it alone, you may be sure that there is something wrong, not with the stock, but with the market. There is absolutely no use in trying to force matters. You are bound to lose if you do. A pool manager should be willing to buy his own stock when he has company, but when he is the only buyer in the market, he'd be an ass to buy it. For every 5,000 shares I buy, the public ought to be willing or able to buy 5,000 more. But I certainly am not going to do all the buying. If I did, all I would succeed in doing would be to get soaked with a lot of long stock that I don't want. There is only one thing to do, and that is to sell, and the only way to sell is to sell." "You mean sell for what you can get?" asked Prentice. "Right," I said. I could see he was getting ready to object. "If I am to sell the pool's stock at all, you can make up your mind that the price is going to break through par and—" "Oh no, never," he yelled. You'd have imagined I was asking him to join a suicide club. "Prentice," I said to him, "it is a cardinal principle of stock manipulation to put up a stock in order to sell it, but you don't sell in bulk on the advance. You can't. The big selling is done on the way down from the top. I cannot put up your stock to 125 or 130. I'd like to, but it can't be done. So you will have to begin your selling from this level. In my opinion, all stocks are going down, and petroleum products isn't going to be the one exception. It is better for it to go down now on the pool's selling than for it to break next month on selling by someone else. It will go down anyhow." I can't see that I said anything harrowing, but you could have heard his howls in China. He simply wouldn't listen to such a thing. It would never do. It would play the dickens with the stock's record, to say nothing of inconvenient possibilities at the banks where the stock was held as collateral on loans, and so on. I told him again that in my judgment, nothing in the world could prevent peat products from breaking 15 or 20 points, because the entire market was headed that way, and I once more said it was absurd to expect his stock to be a dazzling exception. But again, my talk went for nothing. He insisted that I support the stock. Here was a shrewd businessman, one of the most successful promoters of the day, who had made millions in Wall Street deals and knew much more than the average man about the game of speculation, actually insisting on supporting a stock in an incipient bear market. It was his stock, to be sure, but it was nevertheless bad business. So much so that it went against the grain, and I again began to argue with him. But it was no use. He insisted on putting in supporting orders. Of course, when the general market got weak and the decline began in earnest, peat products went with the rest. Instead of selling, I actually bought stock for the insiders' pool by Prentice orders. The only explanation is that Prentice did not believe the bear market was right on top of us. I myself was confident that the bull market was over. I had verified my first surmise by tests not alone in peat products, but in other stocks as well. I didn't wait for the bear market to announce its safe arrival before I started selling. Of course, I didn't sell a share of peat products, though I was short of other stocks. The peat products pool, as I expected, was hung up with all they held to begin with and with all they had to take in their futile effort to hold up the price. In the end, they did liquidate, but at much lower figures than they would have got if Prentice had let me sell when and as I wished. It could not be otherwise. But Prentice still thinks he was right, or says he does. I understand he says the reason I gave him the advice I did was that I was short of other stocks, and the general market was going up. It implies, of course, that the break in peat products that would have resulted from selling out the pool's holdings at any price would have helped my bear position in other stocks. That is all tommyrot. I was not bearish because I was short of stocks. I was bearish because that was the way I sized up the situation, and I sold stock short only after I turned bearish. There never is much money in doing things wrong end to, not in the stock market. My plan for selling the pool's stock was based on what the experience of 20 years told me alone was feasible and therefore wise. Prentice ought to have been enough of a trader to see it as plainly as I did. It was too late to try to do anything else. I suppose Prentice shares the delusion of thousands of outsiders who think a manipulator can do anything. He can't. The biggest thing Keene did was his manipulation of U.S. Steel Common and Preferred in the spring of 1901. He succeeded not because he was clever and resourceful, and not because he had a syndicate of the richest men in the country back of him. He succeeded partly because of those reasons, but chiefly because the general market was right and the public state of mind was right. It isn't good business for a man to act against the teachings of experience and against common sense. But the suckers in Wall Street are not all outsiders. Prentice, grievance against me is what I have just told you. He feels sore because I did my manipulation not as I wanted to, but as he asked me to. There isn't anything mysterious or underhanded or crooked about manipulation designed to sell a stock in bulk, provided such operations are not accompanied by deliberate misrepresentations. Sound manipulation must be based on sound trading principles. People lay great stress on old-time practices, such as wash sales. But I can assure you that the mere mechanics of deception count for very little. The difference between stock market manipulation and the over-the-counter sale of stocks and bonds is in the character of the clientele rather than in the character of the appeal. J.P. Morgan & Co. sell an issue of bonds to the public that is to investors. A manipulator disposes of a block of stock to the public that is to speculators. An investor looks for safety, for permanence of the interest return on the capital he invests. The speculator looks for a quick profit. The manipulator necessarily finds his primary market among speculators who are willing to run a greater than normal business risk so long as they have a reasonable chance to get a big return on their capital. I myself never have believed in blind gambling. I may plunge or I may buy 100 shares, but in either case, I must have a reason for what I do. I distinctly remember how I got into the game of manipulation, that is, in the marketing of stocks for others. It gives me pleasure to recall it because it shows so beautifully the professional Wall Street attitude toward stock market operations. It happened after I had come back, that is, after my Bethlehem steel trade in 1915 started me on the road to financial recovery. I traded pretty steadily and had very good luck. I have never sought newspaper publicity, but neither have I gone out of my way to hide myself. At the same time, you know that professional Wall Street exaggerates both the successes and the failures of whichever operator happens to be active, and of course, the newspapers hear about him and print rumors. I have been broke so many times, according to the gossips, or have made so many millions, according to the same authorities, that my only reaction to such reports is to wonder how and where they are born, and how they grow. I have had broker friend after broker friend bring the same story to me, a little changed each time, improved, more circumstantial. All this preface is to tell you how I first came to undertake the manipulation of a stock for someone else. The stories the newspapers printed of how I had paid back in full the millions I owed did the trick. My plungings and my winnings were so magnified by the newspapers that I was talked about in Wall Street. The day was past when an operator swinging a line of 200,000 shares of stock could dominate the market. But as you know, the public always desires to find successors to the old leaders. It was Mr. Keene's reputation as a skillful stock operator, a winner of millions on his own hook, that made promoters and banking houses apply to him for selling large blocks of securities. In short, his services as manipulator were in demand because of the stories the street had heard about his previous successes as a trader. But Keene was gone past on to that heaven where he once said he wouldn't stay a moment unless he found Sisonby there waiting for him. 2 or 3 other men who made stock market history for a few months had relapsed into the obscurity of prolonged inactivity. I refer particularly to certain of those plunging Westerners who came to Wall Street in 1901 and after making many millions out of their steel holdings remained in Wall Street. They were in reality superpromoters rather than operators of the Keene type. But they were extremely able, extremely rich, and extremely successful in the securities of the companies which they and their friends controlled. They were not really great manipulators, like Keene or Governor Flower. Still, the street found in them plenty to gossip about, and they certainly had a following among the professionals and the sportier commission houses. After they ceased to trade actively, the street found itself without manipulators. At least, it couldn't read about them in the newspapers. You remember the big bull market that began when the stock exchange resumed business in 1915. As the market broadened and the Allies, purchases in this country mounted into billions, we ran into a boom. As far as manipulation went, it wasn't necessary for anybody to lift a finger to create an unlimited market for a war bride. Scores of men made millions by capitalizing contracts or even promises of contracts. They became successful promoters, either with the aid of friendly bankers or by bringing out their companies on the curb market. The public bought anything that was adequately touted. When the bloom wore off the boom, some of these promoters found themselves in need of help from experts in stock salesmanship. When the public is hung up with all kinds of securities, some of them purchased at higher prices, it is not an easy task to dispose of untried stocks. After a boom, the public is positive that nothing is going up. It isn't that buyers become more discriminating, but that the blind buying is over. It is the state of mind that has changed. Prices don't even have to go down to make people pessimistic. It is enough if the market gets dull and stays dull for a time. In every boom, companies are formed primarily, if not exclusively, to take advantage of the public's appetite for all kinds of stocks. Also, there are belated promotions. The reason why promoters make that mistake is that being human, they are unwilling to see the end of the boom. Moreover, it is good business to take chances when the possible profit is big enough. The top is never in sight when the vision is vitiated by hope. The average man sees a stock that nobody wanted at $12 or $14 a share suddenly advance to 30, which surely is the top until it rises to 50. That is absolutely the end of the rise. Then it goes to 60, to 70, to 75. It then becomes a certainty that this stock, which a few weeks ago was selling for less than 15, can't go any higher. But it goes to 80 and to 85. Whereupon the average man, who never thinks of values but of prices, and is not governed in his actions by conditions but by fears, takes the easiest way. He stops thinking that there must be a limit to the advances. That is why those outsiders who are wise enough not to buy at the top make up for it by not taking profits. The big money in booms is always made first by the public on paper, and it remains on paper. Roman 22. One day Jim Barnes, who not only was one of my principal brokers but an intimate friend as well, called on me. He said he wanted me to do him a great favor. He never before had talked that way, and so I asked him to tell me what the favor was, hoping it was something I could do, for I certainly wished to oblige him. He then told me that his firm was interested in a certain stock. In fact, they had been the principal promoters of the company and had placed the greater part of the stock. Circumstances had arisen that made it imperative for them to market a rather large block. Jim wanted me to undertake to do the marketing for him. The stock was Consolidated Stove. I did not wish to have anything to do with it for various reasons, but Barnes, to whom I was under some obligations, insisted on the personal favor phase of the matter, which alone could overcome my objections. He was a good fellow, a friend, and his firm, I gathered, was pretty heavily involved, so in the end I consented to do what I could. It has always seemed to me that the most picturesque point of difference between the war boom and other booms was the part that was played by a type new in stock market affairs, the boy banker. The boom was stupendous, and its origins and causes were plainly to be grasped by all. But at the same time, the greatest banks and trust companies in the country certainly did all they could to help make millionaires overnight of all sorts and conditions of promoters and munition makers. It got so that all a man had to do was to say that he had a friend who was a friend of a member of one of the Allied commissions, and he would be offered all the capital needed to carry out the contracts he had not yet secured. I used to hear incredible stories of clerks becoming presidents of companies doing a business of millions of dollars on money borrowed from trusting trust companies, and of contracts that left a trail of profits as they passed from man to man. A flood of gold was pouring into this country from Europe, and the banks had to find ways of impounding it. The way business was done might have been regarded with misgivings by the old, but there didn't seem to be so many of them about. The fashion for gray-haired presidents of banks was all very well in tranquil times, but youth was the chief qualification in these strenuous times. The banks certainly did make enormous profits. Jim Barnes and his associates, enjoying the friendship and confidence of the youthful president of the Marshall National Bank, decided to consolidate 3 well-known stove companies and sell the stock of the new company to the public that for months had been buying any old thing in the way of engraved stock certificates. One trouble was that the stove business was so prosperous that all 3 companies were actually earning dividends on their common stock for the first time in their history. Their principal stockholders did not wish to part with the control. There was a good market for their stocks on the curb, and they had sold as much as they cared to part with, and they were content with things as they were. Their individual capitalization was too small to justify big market movements, and that is where Jim Barnes' firm came in. It pointed out that the consolidated company must be big enough to list on the stock exchange, where the new shares could be made more valuable than the old ones. It is an old device in Wall Street to change the color of the certificates in order to make them more valuable. Say a stock ceases to be easily vendable at war. Well, sometimes by quadrupling the stock you may make the new shares sell at 30 or 35. This is equivalent to 120 or 140. For the old stock a figure it never could have reached. It seems that Barnes and his associates succeeded in inducing some of their friends, who held speculatively some blocks of Gray Stove Company, a large concern, to come into the consolidation on the basis of 4 shares of Consolidated for each share of Gray. Then the Midland and the Western followed their big sister and came in on the basis of share for share. Theirs had been quoted on the curb at around 25 to 30, and the Gray, which was better known and paid dividends, hung around 125. In order to raise the money to buy out those holders who insisted upon selling for cash, and also to provide additional working capital for improvements and promotion expenses, it became necessary to raise a few millions. So Barnes saw the president of his bank, who kindly lent his syndicate $3,500,000. The collateral was 100,000 shares of the newly organized corporation. The syndicate assured the president, or so I was told, that the price would not go below 50. It would be a very profitable deal as there was big value there. The promoters' first mistake was in the matter of timeliness. The saturation point for new stock issues had been reached by the market, and they should have seen it. But even then, they might have made a fair profit after all if they had not tried to duplicate the unreasonable killings which other promoters had made at the very height of the boom. Now you must not run away with the notion that Jim Barnes and his associates were fools or inexperienced kids. They were shrewd men. All of them were familiar with Wall Street methods, and some of them were exceptionally successful stock traders. But they did rather more than merely overestimate the public's buying capacity. After all, that capacity was something that they could determine only by actual tests. Where they erred more expensively was in expecting the bull market to last longer than it did. I suppose the reason was that these same men had met with such great and particularly with such quick success that they didn't doubt they'd be all through with the deal before the bull market turned. They were all well known and had a considerable following among the professional traders and the wire houses. The deal was extremely well advertised. The newspapers certainly were generous with their space. The older concerns were identified with the stove industry of America, and their product was known the world over. It was a patriotic amalgamation, and there was a heap of literature in the daily papers about the world conquests. The markets of Asia, Africa, and South America were as good as cinched. The directors of the company were all men whose names were familiar to all readers of the financial pages. The publicity work was so well handled, and the promises of unnamed insiders as to what the price was going to do were so definite and convincing that a great demand for the new stock was created. The result was that, when the books were closed, it was found that the stock which was offered to the public at $50 a share had been oversubscribed by 25%. Think of it, the best the promoters should have expected was to succeed in selling the new stock at that price after weeks of work and after putting up the price to 75 or higher in order to average 50. At that, it meant an advance of about 100% in the old prices of the stocks of the constituent companies. That was the crisis, and they did not meet it as it should have been met. It shows you that every business has its own needs. General wisdom is less valuable than specific savvy. The promoters, delighted by the unexpected oversubscription, concluded that the public was ready to pay any price for any quantity of that stock, and they actually were stupid enough to underallot the stock. After the promoters made up their minds to be hoggish, they should have tried to be intelligently hoggish. What they should have done, of course, was to allot the stock in full. That would have made them short to the extent of 25% of the total amount offered for subscription to the public, and that, of course, would have enabled them to support the stock when necessary and at no cost to themselves. Without any effort on their part, they would have been in the strong strategic position that I always try to find myself in when I am manipulating a stock. They could have kept the price from sagging, thereby inspiring confidence in the new stock's stability and in the underwriting syndicate back of it. They should have remembered that their work was not over when they sold the stock offered to the public. That was only a part of what they had to market. They thought they had been very successful, but it was not long before the consequences of their two capital blunders became apparent. The public did not buy any more of the new stock because the entire market developed reactionary tendencies. The insiders got cold feet and did not support consolidated stove, and if insiders don't buy their own stock on recessions, who should? The absence of inside support is generally accepted as a pretty good bear tip. There is no need to go into statistical details. The price of consolidated stove fluctuated with the rest of the market, but it never went above the initial market quotations, which were only a fraction above 50. Barnes and his friends in the end had to come in as buyers in order to keep it above 40. Not to have supported that stock at the outset of its market career was regrettable, but not to have sold all the stock the public subscribed for was much worse. At all events, the stock was duly listed on the New York Stock Exchange, and the price of it duly kept sagging until it nominally stood at 37. And it stood there because Jim Barnes and his associates had to keep it there because their bank had loaned them $35 a share on 100,000 shares. If the bank ever tried to liquidate that loan, there was no telling what the price would break to. The public that had been eager to buy it at 50 now didn't care for it at 37 and probably wouldn't want it at 27. As time went on, the banks' excesses in the matter of extensions of credits made people think. The day of the boy banker was over. The banking business appeared to be on the ragged edge of suddenly relapsing into conservatism. Intimate friends were now asked to pay off loans, for all the world as though they had never played golf with the president. There was no need to threaten on the lender's part or to plead for more time on the borrower's. The situation was highly uncomfortable for both. The bank, for example, with which my friend Jim Barnes did business, was still kindly disposed. But it was a case of, for heaven's sake, take up that loan or we'll all be in a dickens of a mess. The character of the mess and its explosive possibilities were enough to make Jim Barnes come to me to ask me to sell the 100,000 shares for enough to pay off the bank's $3,500,000 loan. Jim did not now expect to make a profit on that stock. If the syndicate only made a small loss on it, they would be more than grateful. It seemed a hopeless task. The general market was neither active nor strong, though at times there were rallies when everybody perked up and tried to believe the bull swing was about to resume. The answer I gave Barnes was that I'd look into the matter and let him know under what conditions I'd undertake the work. Well, I did look into it. I didn't analyze the company's last annual report. My studies were confined to the stock market phases of the problem. I was not going to tout the stock for a rise on its earnings or its prospects, but to dispose of that block in the open market. All I considered was what should, could, or might help or hinder me in that task. I discovered, for one thing, that there was too much stock held by too few people, that is, too much for safety and far too much for comfort. Clifton P. Cain and Co., bankers and brokers, members of the New York Stock Exchange, were carrying 70,000 shares. They were intimate friends of Barnes and had been influential in effecting the consolidation, as they had made a specialty of stove stocks for years. Their customers had been let into the good thing. Ex-Senator Samuel Gordon, who was the special partner in his nephew's firm, Gordon Bros, was the owner of a second block of 70,000 shares, and the famous Joshua Wolfe had 60,000 shares. This made a total of 200,000 shares of consolidated stove held by this handful of veteran Wall Street professionals. They did not need any kind person to tell them when to sell their stock. If I did anything in the manipulating line calculated to bring in public buying, that is to say, if I made the stock strong and active, I could see Cain and Gordon and Wolfe unloading, and not in homeopathic doses either. The vision of their 200,000 shares Niagaring into the market was not exactly entrancing. Don't forget that the cream was off the bull movement and that no overwhelming demand was going to be manufactured by my operations, however skillfully conducted they might be. Jim Barnes had no illusions about the job he was modestly sidestepping in my favor. He had given me a waterlogged stock to sell on a bull market that was about to breathe its last. Of course, there was no talk in the newspapers about the ending of the bull market, but I knew it, and Jim Barnes knew it, and you bet the bank knew it. Still, I had given Jim my word, so I sent for Cain, Gordon, and Wolfe. Their 200,000 shares was the sword of Damocles. I thought I'd like to substitute a steel chain for the hair. The easiest way, it seemed to me, was by some sort of reciprocity agreement. If they helped me passively by holding off while I sold the bank's 100,000 shares, I would help them actively by trying to make a market for all of us to unload on. As things were, they couldn't sell 1/10 of their holdings without having consolidated stove break wide open, and they knew it so well that they had never dreamed of trying. All I asked of them was judgment in timing the selling and an intelligent unselfishness in order not to be unintelligently selfish. It never pays to be a dog in the manger in Wall Street or anywhere else. I desired to convince them that premature or ill-considered unloading would prevent complete unloading. Time urged. I hoped my proposition would appeal to them because they were experienced Wall Street men and had no illusions about the actual demand for consolidated stove. Clifton P. Cain was the head of a prosperous commission house with branches in 11 cities and customers by the hundreds. His firm had acted as managers for more than one pool in the past. Senator Gordon, who held 70,000 shares, was an exceedingly wealthy man. His name was as familiar to the readers of the metropolitan press as though he had been sued for breach of promise by a 16-year-old manicurist possessing a $5,000 mink coat and 132 letters from the defendant. He had started his nephews in business as brokers, and he was a special partner in their firm. He had been in dozens of pools. He had inherited a large interest in the Midland Stove Company, and he got 100,000 shares of Consolidated Stove for it. He had been carrying enough to disregard Jim Barnes, Wild Bull tips, and had cashed in on 30,000 shares before the market petered out on him. He told a friend later that he would have sold more, only the other big holders, who were old and intimate friends, pleaded with him not to sell anymore, and out of regard for them he stopped. Besides which, as I said, he had no market to unload on. The third man was Joshua Wolfe. He was probably the best known of all the traders. For 20 years, everybody had known him as one of the plungers on the floor. In bidding up stocks or offering them down, he had few equals, for 10 or 20,000 shares meant no more to him than 200 or 300. Before I came to New York, I had heard of him as a plunger. He was then trailing with a sporting coterie that played a no-limit game, whether on the racetrack or in the stock market. They used to accuse him of being nothing but a gambler, but he had real ability and a strongly developed aptitude for the speculative game. At the same time, his reputed indifference to highbrow pursuits made him the hero of numberless anecdotes. One of the most highly circulated of the yarns was that Joshua was a guest at what he called a swell dinner, and by some oversight of the hostess, several of the other guests began to discuss literature before they could be stopped. A girl who sat next to Josh and had not heard him use his mouth except for masticating purposes turned to him and, looking anxious to hear the great financier's opinion, asked him, "Oh, Mr. Wolfe, what do you think of Balzac?" Josh politely ceased to masticate, swallowed, and answered, "I never trade in them curb stocks." Such were the three largest individual holders of Consolidated Stove. When they came over to see me, I told them that if they formed a syndicate to put up some cash and gave me a call on their stock at a little above the market, I would do what I could to make a market. They promptly asked me how much money would be required. I answered, "You've had that stock a long time, and you can't do a thing with it. Between the three of you, you've got 200,000 shares, and you know very well that you haven't the slightest chance of getting rid of it unless you make a market for it. It's got to be some market to absorb what you've got to give it, and it will be wise to have enough cash to pay for whatever stock it may be necessary to buy at first. It's no use to begin and then have to stop because there isn't enough money. I suggest that you form a syndicate and raise $6 million in cash. Then give the syndicate a call on your 200,000 shares at 40 and put all your stock in escrow. If everything goes well, you chaps will get rid of your dead pet, and the syndicate will make some money. As I told you before, there had been all sorts of rumors about my stock market winnings. I suppose that helped, for nothing succeeds like success. At all events, I didn't have to do much explaining to these chaps. They knew exactly how far they'd get if they tried to play a lone hand. They thought mine was a good plan. When they went away, they said they would form the syndicate at once. They didn't have much trouble in inducing a lot of their friends to join them. I suppose they spoke with more assurance than I had of the syndicate's profits. From all I heard, they really believed it, so theirs were no conscienceless tips. At all events, the syndicate was formed in a couple of days. Kane, Gordon, and Wolfe gave calls on the 200,000 shares at 40, and I saw to it that the stock itself was put in escrow, so that none of it would come out on the market if I should put up the price. I had to protect myself. More than one promising deal has failed to pan out as expected because the members of the pool or clique failed to keep faith with one another. Dog has no foolish prejudices against eating dog in Wall Street. At the time, the Second American Steel and Wire Company was brought out. The insiders accused one another of breach of faith and trying to unload. There had been a gentleman's agreement between John W. Gates and his pals and the Seligmans and their banking associates. Well, I heard somebody in a broker's office reciting this quatrain, which was said to have been composed by John W. Gates. The tarantula jumped on the centipede's back and chortled with ghoulish glee. "I'll poison this murderous son of a gun. If I don't, he'll poison me." Mind you, I do not mean for one moment to imply that any of my friends in Wall Street would even dream of double-crossing me in a stock deal. But on general principles, it is just as well to provide for any and all contingencies. It's plain sense. After Wolfe and Kane and Gordon told me that they had formed their syndicate to put up $6 million in cash, there was nothing for me to do but wait for the money to come in. I had urged the vital need of haste. Nevertheless, the money came in driblets. I think it took 4 or 5 installments. I don't know what the reason was, but I remember that I had to send out an SOS call to Wolf and Kane and Gordon. That afternoon, I got some big checks that brought the cash in my possession to about $4 million and the promise of the rest in a day or two. It began to look as though the syndicate might do something before the bull market passed away. At best, it would be no cinch, and the sooner I began work, the better. The public had not been particularly keen about new market movements in inactive stocks, but a man could do a great deal to arouse interest in any stock with $4 million in cash. It was enough to absorb all the probable offerings. If time urged, as I had said, there was no sense in waiting for the other $2 million. The sooner the stock got up to 50, the better for the syndicate. That was obvious. The next morning at the opening, I was surprised to see that there were unusually heavy dealings in Consolidated Stove. As I told you before, the stock had been waterlogged for months. The price had been pegged at 37, Jim Barnes taking good care not to let it go any lower on account of the big bank loan at 35. But as for going any higher, he'd as soon expect to see the Rock of Gibraltar shimmying across the strait as to see Consolidated Stove do any climbing on the tape. Well, sir, this morning there was quite a demand for the stock, and the price went up to 39. In the first hour of the trading, the transactions were heavier than for the whole previous half year. It was the sensation of the day and affected bullishly the entire market. I heard afterwards that nothing else was talked about in the customers' rooms of the commission houses. I didn't know what it meant, but it didn't hurt my feelings any to see Consolidated Stove perk up. As a rule, I do not have to ask about any unusual movement in any stock because my friends on the floor brokers who do business for me, as well as personal friends among the room traders, keep me posted. They assume I'd like to know, and they telephone me any news or gossip they pick up. On this day, all I heard was that there was unmistakable inside buying in Consolidated Stove. There wasn't any washing. It was all genuine. The purchasers took all the offerings from 37 to 39, and when importuned for reasons or begged for a tip, flatly refused to give any. This made the wily and watchful traders conclude that there was something doing, something big. When a stock goes up on buying by insiders who refuse to encourage the world at large to follow suit, the ticker hounds begin to wonder aloud when the official notice will be given out. I didn't do anything myself. I watched and wondered and kept track of the transactions. But on the next day, the buying was not only greater in volume, but more aggressive in character. The selling orders that had been on the specialists' books for months at above the pegged price of 37 were absorbed without any trouble, and not enough new selling orders came in to check the rise. Naturally, up went the price. It crossed 40. Presently it touched 42. The moment it touched that figure, I felt that I was justified in starting to sell the stock the bank held as collateral. Of course, I figured that the price would go down on my selling, but if my average on the entire line was 37, I'd have no fault to find. I knew what the stock was worth, and I had gathered some idea of the vendability from the months of inactivity. Well, sir, I let them have stock carefully until I had got rid of 30,000 shares. And the advance was not checked. That afternoon I was told the reason for that opportune but mystifying rise. It seems that the floor traders had been tipped off after the close the night before, and also the next morning before the opening, that I was bullish as blazes on Consolidated Stove, and was going to rush the price right up 15 or 20 points without a reaction, as was my custom, that is, my custom according to people who never kept my books. The teepster-in-chief was no less a personage than Joshua Wolf. It was his own inside buying that started the rise of the day before. His cronies among the floor traders were only too willing to follow his tip, for he knew too much to give wrong steers to his fellows. As a matter of fact, there was not so much stock pressing on the market as had been feared. Consider that I had tied up 300,000 shares, and you will realize that the old fears had been well-founded. It now proved less of a job than I had anticipated to put up the stock. After all, Governor Flower was right. Whenever he was accused of manipulating his firm's specialties, like Chicago Gas, Federal Steel, or B.R.T., he used to say, "The only way I know of making a stock go up is to buy it." That also was the floor trader's only way, and the price responded. On the next day, before breakfast, I read in the morning papers what was read by thousands and what undoubtedly was sent over the wires to hundreds of branches and out-of-town offices, and that was that Larry Livingston was about to begin active bull operations in Consolidated Stove. The additional details differed. One version had it that I had formed an insider's pool and was going to punish the overextended short interest. Another hinted at dividend announcements in the near future. Another reminded the world that what I usually did to a stock I was bullish on was something to remember. Still, another accused the company of concealing its assets in order to permit accumulation by insiders, and all of them agreed that the rise hadn't fairly started. By the time I reached my office and read my mail before the market opened, I was made aware that the street was flooded with red-hot tips to buy Consolidated Stove at once. My telephone bell kept ringing, and the clerk who answered the calls heard the same question asked in one form or another 100 times that morning. Was it true that Consolidated Stove was going up? I must say that Joshua Wolf and Kane and Gordon and possibly Jim Barnes handled that little tipping job mighty well. I had no idea that I had such a following. Why, that morning the buying orders came in from all over the country, orders to buy thousands of shares of a stock that nobody wanted at any price 3 days before. And don't forget that, as a matter of fact, all that the public had to go by was my newspaper reputation as a successful plunger, something for which I had to thank an imaginative reporter or two. Well, sir, on that, the third day of the rise, I sold Consolidated Stove, and on the fourth day and the fifth. And the first thing I knew, I had sold for Jim Barnes the 100,000 shares of stock, which the Marshall National Bank held as collateral on the $3,500,000 loan that needed paying off. If the most successful manipulation consists of that in which the desired end is gained at the least possible cost to the manipulator, the Consolidated Stove deal is by all means the most successful of my Wall Street career. Why, at no time did I have to take any stock. I didn't have to buy first in order to sell the more easily later on. I did not put up the price to the highest possible point and then begin my real selling. I didn't even do my principal selling on the way down, but on the way up. It was like a dream of paradise to find an adequate buying power created for you without your stirring a finger to bring it about, particularly when you were in a hurry. I once heard a friend of Governor Flowers say that in one of the great bull leaders' operations for the account of a pool in B.R.T. The pool sold 50,000 shares of the stock at a profit, but Flower and Co. got commissions on more than 250,000 shares, and W.P. Hamilton says that to distribute 220,000 shares of Amalgamated Copper. James R. Keene must have traded in at least 700,000 shares of the stock during the necessary manipulation. Some commission bill. Think of that, and then consider that the only commissions that I had to pay were the commissions on the 100,000 shares I actually sold for Jim Barnes. I call that some saving. Having sold what I had engaged to sell for my friend Jim, and all the money the syndicate had agreed to raise not having been sent in, and feeling no desire to buy back any of the stock I had sold, I rather think I went away somewhere for a short vacation. I do not remember exactly, but I do remember very well that I let the stock alone and that it was not long before the price began to sag. One day, when the entire market was weak, some disappointed bull wanted to get rid of his Consolidated Stove in a hurry, and on his offerings the stock broke below the call price, which was 40. Nobody seemed to want any of it. As I told you before, I wasn't bullish on the general situation, and that made me more grateful than ever for the miracle that had enabled me to dispose of the 100,000 shares without having to put the price up 20 or 30 points in a week, as the kindly teepsters had prophesied. Finding no support, the price developed a habit of declining regularly until one day it broke rather badly and touched 32. That was the lowest that had ever been recorded for it, for, as you will remember, Jim Barnes and the original syndicate had pegged it at 37 in order not to have their 100,000 shares dumped on the market by the bank. I was in my office that day peacefully studying the tape when Joshua Wolf was announced. I said I would see him. He rushed in. He is not a very large man, but he certainly seemed all swelled up with anger, as I instantly discovered. He ran to where I stood by the ticker and yelled, "Hey, what the devil's the matter?" "Have a chair, Mr. Wolf," I said politely and sat down myself to encourage him to talk calmly. "I don't want any chair, I want to know what it means. He cried at the top of his voice. What does what mean? What in hell are you doing to it? What am I doing to what? That stock, that stock. What stock? I asked him. But that only made him see red, for he shouted, Consolidated stove. What are you doing to it? Nothing, absolutely nothing. What's wrong? I said. He stared at me fully 5 seconds before he exploded. Look at the price. Look at it. He certainly was angry, so I got up and looked at the tape. I said, the price of it is now 31 a quarter. Yes, 31 and a quarter, and I've got a raft of it. I know you have 60,000 shares. You have had it a long time, because when you originally bought your gray stove. But he didn't let me finish. He said, but I bought a lot more. Some of it cost me as high as 40, and I've got it yet. He was glaring at me so hostilely that I said, I didn't tell you to buy it. You didn't what? I didn't tell you to load up with it. I didn't say you did, but you were going to put it up. Why was I interrupted. He looked at me, unable to speak for anger. When he found his voice again, he said, you were going to put it up. You had the money to buy it. Yes, but I didn't buy a share, I told him. That was the last straw. You didn't buy a share, and you had over 4 million in cash to buy with. You didn't buy any. Not a share, I repeated. He was so mad by now that he couldn't talk plainly. Finally, he managed to say, what kind of a game do you call that? He was inwardly accusing me of all sorts of unspeakable crimes. I sure could see a long list of them in his eyes. It made me say to him, what you really mean to ask me, Wolf, is why I didn't buy from you above 50 the stock you bought below 40. Isn't that it? No, it is. You had a call at 40 and 4 million in cash to put up the price with. Yes, but I didn't touch the money, and the syndicate has not lost a cent by my operations. Look here, Livingston, he began. But I didn't let him say any more. You listened to me, Wolf. You knew that the 200,000 shares you and Gordon and Kane held were tied up, and that there wouldn't be an awful lot of floating stock to come on the market if I put up the price, as I'd have to do for 2 reasons. The first, to make a market for the stock, and the second, to make a profit out of the call at 40. But you weren't satisfied to get 40 for the 60,000 shares you've been lugging for months, or with your share of the syndicate profits, if any. So you decided to take on a lot of stock under 40 to unload on me when I put the price up with the syndicate's money, as you were sure I meant to do. You'd buy before I did, and you'd unload before I did. In all probability, I'd be the one to unload on. I suspect you figured on my having to put the price up to 60. It was such a cinch that you probably bought 10,000 shares strictly for unloading purposes, and to make sure somebody held the bag if I didn't, you tipped off everybody in the United States, Canada, and Mexico without thinking of my added difficulties. All your friends knew what I was supposed to do. Between their buying and mine, you were going to be all hunky. Well, your intimate friends to whom you gave the tip passed it on to their friends after they had bought their lines, and the third stratum of tip takers planned to supply the 4th, 5th, and possibly 6th strata of suckers, so that when I finally came to do some selling, I'd find myself anticipated by a few thousands of wise speculators. It was a friendly thought, that notion of yours, Wolf. You can't imagine how surprised I was when Consolidated Stove began to go up before I even thought of buying a single share, or how grateful, either, when the underwriting syndicate sold 100,000 shares around 40 to the people who were going to sell those same shares to me at 50 or 60. I sure was a sucker not to use the 4 millions to make money for them, was I? The cash was supplied to buy stock with, but only if I thought it necessary to do so. Well, I didn't. Joshua had been in Wall Street long enough not to let anger interfere with business. He cooled off as he heard me, and when I was through talking, he said in a friendly tone of voice, Look here, Larry, old chap, what shall we do? Do whatever you please. Ah, be a sport. What would you do if you were in our place? If I were in your place, I said solemnly, do you know what I'd do? What? I'd sell out, I told him. He looked at me a moment, and without another word turned on his heel and walked out of my office. He's never been in it since. Not long after that, Senator Gordon also called. He, too, was quite peevish and blamed me for their troubles. Then Kane joined the Anvil chorus. They forgot that their stock had been unsaleable in bulk when they formed the syndicate. All they could remember was that I didn't sell their holdings when I had the syndicate's millions and the stock was active at 44, and that now it was 30 and dull as dishwater. To their way of thinking, I should have sold out at a good fat profit. Of course, they also cooled down in due time. The syndicate wasn't out a cent, and the main problem remained unchanged: to sell their stock. A day or two later, they came back and asked me to help them out. Gordon was particularly insistent, and in the end, I made them put in their pooled stock at 25.5. My fee for my services was to be 1/2 of whatever I got above that figure. The last sale had been at about 30. Their eye was with their stock to liquidate. Given general market conditions and specifically the behavior of Consolidated Stove, there was only one way to do it, and that was, of course, to sell on the way down and without first trying to put up the price, and I certainly would have got stock by the ream on the way up. But on the way down, I could reach those buyers who always argue that a stock is cheap when it sells 15 or 20 points below the top of the movement, particularly when that top is a matter of recent history. A rally is due, in their opinion. After seeing Consolidated Stove sell up to close to 44, it sure looked like a good thing below 30. It worked out as always. Bargain hunters bought it in sufficient volume to enable me to liquidate the pool's holdings. But do you think that Gordon or Wolf or Kane felt any gratitude? Not a bit of it. They are still sore at me, or so their friends tell me. They often tell people how I did them. They cannot forgive me for not putting up the price on myself, as they expected. As a matter of fact, I never would have been able to sell the bank's 100,000 shares if Wolf and the rest had not passed around those red-hot bull tips of theirs. If I had worked as I usually do, that is, in a logical, natural way, I would have had to take whatever price I could get. I told you we ran into a declining market. The only way to sell on such a market is to sell not necessarily recklessly, but really regardless of price. No other way was possible, but I suppose they do not believe this. They are still angry. I am not. Getting angry doesn't get a man anywhere. More than once it has been borne in on me that a speculator who loses his temper is a goner. In this case, there was no aftermath to the grouches. But I'll tell you something curious. One day Mrs. Livingston went to a dressmaker who had been warmly recommended to her. The woman was competent and obliging and had a very pleasing personality. At the third or fourth visit, when the dressmaker felt less like a stranger, she said to Mrs. Livingston, "I hope Mr. Livingston puts up Consolidated Stove soon. We have some that we bought because we were told he was going to put it up, and we'd always heard that he was very successful in all his deals. I tell you, it isn't pleasant to think that innocent people may have lost money following a tip of that sort. Perhaps you understand why I never give any myself. That dressmaker made me feel that in the matter of grievances, I had a real one against Wolf." Roman 23. Speculation in stocks will never disappear. It isn't desirable that it should. It cannot be checked by warnings as to its dangers. You cannot prevent people from guessing wrong no matter how able or how experienced they may be. Carefully laid plans will miscarry because the unexpected and even the unexpectable will happen. Disaster may come from a convulsion of nature or from the weather, from your own greed or from some man's vanity, from fear or from uncontrolled hope. But apart from what one might call his natural foes, a speculator in stocks has to contend with certain practices or abuses that are indefensible normally as well as commercially. As I look back and consider what were the common practices 25 years ago when I first came to Wall Street, I have to admit that there have been many changes for the better. The old-fashioned bucket shops are gone, though bucketeering, brokerage, houses still prosper at the expense of men and women who persist in playing the game of getting rich quick. The stock exchange is doing excellent work not only in getting after these out-and-out swindlers, but in insisting upon strict adherence to its rules by its own members. Many wholesome regulations and restrictions are now strictly enforced, but there is still room for improvement. The ingrained conservatism of Wall Street, rather than ethical callousness, is to blame for the persistence of certain abuses. Difficult as profitable stock speculation always has been, it is becoming even more difficult every day. It was not so long ago when a real trader could have a good working knowledge of practically every stock on the list. In 1901, when J.P. Morgan brought out the United States Steel Corporation, which was merely a consolidation of lesser consolidations, most of which were less than 2 years old. The stock exchange had 275 stocks on its list and about 100 in its unlisted department. And this included a lot that a chap didn't have to know anything about because they were small issues, or inactive by reason of being minority or guaranteed stocks, and therefore lacking in speculative attractions. In fact, an overwhelming majority were stocks in which there had not been a sale in years. Today, there are about 900 stocks on the regular list, and in our recent active markets, about 600 separate issues were traded in. Moreover, the old groups or classes of stocks were easier to keep track of. They not only were fewer, but the capitalization was smaller, and the news a trader had to be on the lookout for did not cover so wide a field. But today, a man is trading in everything. Almost every industry in the world is represented. It requires more time and more work to keep posted, and to that extent speculation has become much more difficult for those who operate intelligently. There are many thousands of people who buy and sell stocks speculatively, but the number of those who speculate profitably is small. As the public always is, in the market to some extent, it follows that there are losses by the public all the time. The speculators' deadly enemies are ignorance, greed, fear, and hope. All the statute books in the world and all the rules of all the exchanges on earth cannot eliminate these from the human animal. Accidents which knock carefully conceived plans, sky high, also are beyond regulation by bodies of cold-blooded economists or warm-hearted philanthropists. There remains another source of loss, and that is deliberate misinformation as distinguished from straight tips. And because it is apt to come to a stock trader variously disguised and camouflaged, it is the more insidious and dangerous. The average outsider, of course, trades either on tips or on rumors, spoken or printed, direct or implied. Against ordinary tips you cannot guard. For instance, a lifelong friend sincerely desires to make you rich by telling you what he has done, that is, to buy or sell some stock. His intent is good. If the tip goes wrong, what can you do? Also, against the professional or crooked tipster, the public is protected to about the same extent that he is against gold bricks or wood alcohol. But against the typical Wall Street rumors, the speculating public has neither protection nor redress. Wholesale dealers in securities, manipulators, pools, and individuals resort to various devices to aid them in disposing of their surplus holdings at the best possible prices. The circulation of bullish items by the newspapers and the tickers is the most pernicious of all. Get the slips of the financial news agencies any day, and it will surprise you to see how many statements of an implied semi-official nature they print. The authority is some leading insider, or a prominent director, or a high official or someone in authority who presumably knows what he is talking about. Here are today's slips. I pick an item at random. Listen to this. A leading banker says it is too early yet to expect a declining market. Did a leading banker really say that? And if he said it, why did he say it? Why does he not allow his name to be printed? Is he afraid that people will believe him if he does? Here is another one about a company, the stock of which has been active this week. This time, the man who makes the statement is a prominent director. Now, which if any of the company's dozen directors is doing the talking, it is plain that by remaining anonymous nobody can be blamed for any damage that may be done by the statement. Quite apart from the intelligent study of speculation, everywhere the trader in stocks must consider certain facts in connection with the game in Wall Street. In addition to trying to determine how to make money, one must also try to keep from losing money. It is almost as important to know what not to do as to know what should be done. It is therefore well to remember that manipulation of some sort enters into practically all advances in individual stocks, and that such advances are engineered by insiders with one object in view and one only, and that is to sell at the best profit possible. However, the average broker's customer believes himself to be a businessman from Missouri if he insists upon being told why a certain stock goes up. Naturally, the manipulators explain the advance in a way calculated to facilitate distribution. I am firmly convinced that the public's losses would be greatly reduced if no anonymous statements of a bullish nature were allowed to be printed. I mean statements calculated to make the public buy or hold stocks. The overwhelming majority of the bullish articles printed on the authority of unnamed directors or insiders convey unreliable and misleading impressions to the public. The public loses many millions of dollars every year by accepting such statements as semi-official and therefore trustworthy. Say, for example, that a company has gone through a period of depression in its particular line of business. The stock is inactive. The quotation represents the general and presumably accurate belief of its actual value. If the stock were too cheap at that level, somebody would know it and buy it, and it would advance. If too dear, somebody would know enough to sell it, and the price would decline. As nothing happens one way or another, nobody talks about it or does anything. The turn comes in the line of business the company is engaged in. Who are the first to know it, the insiders or the public? You can bet it isn't the public. What happens next? Why, if the improvement continues, the earnings will increase and the company will be in position to resume dividends on the stock, or, if dividends were not discontinued, to pay a higher rate. That is, the value of the stock will increase. Say that the improvement keeps up. Does the management make public that glad fact? Does the president tell the stockholders? Does a philanthropic director come out with a signed statement for the benefit of that part of the public that reads the financial page in the newspapers and the slips of the news agencies? Does some modest insider pursuing his usual policy of anonymity come out with an unsigned statement to the effect that the company's future is most promising? Not this time. Not a word is said by anyone, and no statement whatever is printed by newspapers or tickers. The value-making information is carefully kept from the public, while the now taciturn, prominent insiders go into the market and buy all the cheap stock they can lay their hands on. As this well-informed but unostentatious buying keeps on, the stock rises. The financial reporters, knowing that the insiders ought to know the reason for the rise, ask questions. The unanimously anonymous insiders unanimously declare that they have no news to give out. They do not know that there is any warrant for the rise. Sometimes they even state that they are not particularly concerned with the vagaries of the stock market or the actions of stock speculators. The rise continues, and there comes a happy day when those who know have all the stock they want or can carry. The street at once begins to hear all kinds of bullish rumors. The tickers tell the traders, on good authority, that the company has definitely turned the corner. The same modest director, who did not wish his name used when he said he knew no warrant for the rise in the stock, is now quoted, of course, not by name, as saying that the stockholders have every reason to feel greatly encouraged over the outlook. Urged by the deluge of bullish news items, the public begins to buy the stock. These purchases help to put the price still higher. In due course, the predictions of the uniformly unnamed directors come true, and the company resumes dividend payments, or increases the rate, as the case may be. With that, the bullish items multiply. They not only are more numerous than ever but much more enthusiastic. A leading director, asked point-blank for a statement of conditions, informs the world that the improvement is more than keeping up. A prominent insider, after much coaxing, is finally induced by a news agency to confess that the earnings are nothing short of phenomenal. A well-known banker, who is affiliated in a business way with the company, is made to say that the expansion in the volume of sales is simply unprecedented in the history of the trade. If not another order came in, the company would run night and day for heaven knows how many months. A member of the Finance Committee, in a double-leaded manifesto, expresses his astonishment at the public's astonishment over the stock's rise. The only astonishing thing is the stock's moderation in the climbing line. Anybody who will analyze the forthcoming annual report can easily figure how much more than the market price the book value of the stock is. But in no instance is the name of the communicative philanthropist given. As long as the earnings continue good and the insiders do not discern any sign of a let-up in the company's prosperity, they sit on the stock they bought at the low prices. There is nothing to put the price down, so why should they sell? But the moment there is a turn for the worse in the company's business, what happens? Do they come out with statements or warnings or the faintest of hints? Not much. The trend is now downward. Just as they bought without any flourish of trumpets when the company's business turned for the better, they now silently sell. On this inside, selling the stock naturally declines. Then the public begins to get the familiar explanations. A leading insider asserts that everything is okay and the decline is merely the result of selling by bears who are trying to affect the general market. If on one fine day, after the stock has been declining for some time, there should be a sharp break, the demand for reasons or explanations becomes clamorous. Unless somebody says something, the public will fear the worst. So the news tickers now print something like this. When we asked a prominent director of the company to explain the weakness in the stock, he replied that the only conclusion he could arrive at was that the decline today was caused by a bear drive. Underlying conditions are unchanged. The business of the company was never better than at present, and the probabilities are that unless something entirely unforeseen happens in the meanwhile, there will be an increase in the rate at the next dividend meeting. The bear party in the market has become aggressive, and the weakness in the stock was clearly a raid intended to dislodge weakly held stock. The news tickers, wishing to give good measure, as likely as not will go on to state that they are reliably informed that most of the stock bought on the day's decline was taken by inside interests, and that the bears will find that they have sold themselves into a trap. There will be a day of reckoning. In addition to the losses sustained by the public through believing bullish statements and buying stocks, there are the losses that come through being dissuaded from selling out. The next best thing to having people buy the stock the prominent insider wishes to sell is to prevent people from selling the same stock when he does not wish to support or accumulate it. What is the public to believe after reading the statement of the prominent director? What can the average outsider think? Of course, that the stock should never have gone down, that it was forced down by bear selling, and that as soon as the bears stop, the insiders will engineer a punitive advance during which the shorts will be driven to cover at high prices. The public properly believes this because it is exactly what would happen if the decline had in truth been caused by a bear raid. The stock in question, notwithstanding all the threats or promises of a tremendous squeeze of the overextended short interest, does not rally. It keeps on going down. It can't help it. There has been too much stock fed to the market from the inside to be digested. And this inside stock that has been sold by the prominent directors and leading insiders becomes a football among the professional traders. It keeps on going down. There seems to be no bottom for it. The insiders, knowing that trade conditions will adversely affect the company's future earnings, do not dare to support that stock until the next turn for the better in the company's business. Then there will be inside buying and inside silence. I have done my share of trading and have kept fairly well posted on the stock market for many years, and I can say that I do not recall an instance when a bear raid caused a stock to decline extensively. What was called bear raiding was nothing but selling based on accurate knowledge of real conditions. But it would not do to say that the stock declined on inside selling or on inside non-buying. Everybody would hasten to sell, and when everybody sells and nobody buys, there is the dickens to pay. The public ought to grasp firmly this one point, that the real reason for a protracted decline is never bear raiding. When a stock keeps on going down, you can bet there is something wrong with it, either with the market for it or with the company. If the decline were unjustified, the stock would soon sell below its real value, and that would bring in buying that would check the decline. As a matter of fact, the only time a bear can make big money selling a stock is when that stock is too high. And you can gamble your last cent on the certainty that insiders will not proclaim that fact to the world. Of course, the classic example is the New Haven. Everybody knows today what only a few knew at the time. The stock sold at $255 in 1902 and was the premier railroad investment of New England. A man in that part of the country measured his respectability and standing in the community by his holdings of it. If somebody had said that the company was on the road to insolvency, he would not have been sent to jail for saying it. They would have clapped him in an insane asylum with other lunatics. But when a new and aggressive president was placed in charge by Mr. Morgan and the debacle began, it was not clear from the first that the new policies would land the road where it did. But as property after property began to be saddled in the consolidated road at inflated prices, a few clear-sighted observers began to doubt the wisdom of the Mellon policies. A trolley system was bought for $2 million and sold to the New Haven for $10 million, whereupon a reckless man or two committed lèse-majesté by saying that the management was acting recklessly. Hinting that not even the New Haven could stand such extravagance was like impugning the strength of Gibraltar. Of course, the first to see breakers ahead were the insiders. They became aware of the real condition of the company, and they reduced their holdings of the stock. On their selling as well as on their non-support, the price of New England's gilt-edged railroad stock began to yield. Questions were asked, and explanations were demanded as usual, and the usual explanations were promptly forthcoming. Prominent insiders declared that there was nothing wrong that they knew of and that the decline was due to reckless bear selling. So the investors of New England kept their holdings of New York, New Haven, and Hartford stock. Why shouldn't they? Didn't insiders say there was nothing wrong and cry bear selling? Didn't dividends continue to be declared and paid? In the meantime, the promised squeeze of the bears did not come, but new low records did. The insider selling became more urgent and less disguised. Nevertheless, public-spirited men in Boston were denounced as stock jobbers and demagogues for demanding a genuine explanation for the stock's deplorable decline that meant appalling losses to everybody in New England who had wanted a safe investment and a steady dividend payer. That historic break from $255 to $12 a share never was and never could have been a bear drive. It was not started, and it was not kept up by bear operations. The insiders sold right along and always at higher prices than they could have done if they had told the truth or allowed the truth to be told. It did not matter whether the price was $250 or $200 or $150 or $100 or $50 or $25. It still was too high for that stock, and the insiders knew it and the public did not. The public might profitably consider the disadvantages under which it labors when it tries to make money buying and selling the stock of a company, concerning whose affairs only a few men are in position to know the whole truth. The stocks which have had the worst breaks in the past 20 years did not decline on bear rating. But the easy acceptance of that form of explanation has been responsible for losses by the public amounting to millions upon millions of dollars. It has kept people from selling who did not like the way his stock was acting and would have liquidated if they had not expected the price to go right back after the bears stopped their rating. I used to hear Keene blamed in the old days. Before him, they used to accuse Charlie Woerishofer or Addison Kamek. Later on, I became the stock excuse. I recall the case of Intervale Oil. There was a pool in it that put the stock up and found some buyers on the advance. The manipulators ran the price to $50. There the pool sold, and there was a quick break. The usual demand for explanations followed. Why was Intervale so weak? Enough people asked this question to make the answer important news. One of the financial news tickers called up the brokers who knew the most about Intervale Oil's advance and ought to be equally well posted as to the decline. What did these brokers, members of the bull pool, say when the news agency asked them for a reason that could be printed and sent broadcast over the country? Why, that Larry Livingston was raiding the market. And that wasn't enough. They added that they were going to get him. But of course, the Intervale pool continued to sell. The stock only stood then about $12 a share, and they could sell it down to $10 or lower, and their average selling price would still be above cost. It was wise and proper for insiders to sell on the decline. But for outsiders who had paid $35 or $40, it was a different matter. Reading what the tickers printed, their outsiders held on and waited for Larry Livingston to get what was coming to him at the hands of the indignant inside pool. In a bull market, and particularly in booms, the public at first makes money which it later loses simply by overstaying the bull market. This talk of bear raids helps them to overstay. The public should beware of explanations that explain only what unnamed insiders wish the public to believe. Roman 24. The public always wants to be told. That is what makes tip-giving and tip-taking universal practices. It is proper that brokers should give their customers trading advice through the medium of their market letters as well as by word of mouth. But brokers should not dwell too strongly on actual conditions, because the course of the market is always from 6 to 9 months ahead of actual conditions. Today's earnings do not justify brokers in advising their customers to buy stocks unless there is some assurance that 6 or 9 months from today the business outlook will warrant the belief that the same rate of earnings will be maintained. If on looking that far ahead you can see, reasonably clearly, that conditions are developing which will change the present actual power, the argument about stocks being cheap today will disappear. The trader must look far ahead, but the broker is concerned with getting commissions now, hence the inescapable fallacy of the average market letter. Brokers make their living out of commissions from the public, and yet they will try to induce the public through their market letters or by word of mouth to buy the same stocks in which they have received selling orders from insiders or manipulators. It often happens that an insider goes to the head of a brokerage concern and says, "I wish you'd make a market in which to dispose of 50,000 shares of my stock." The broker asks for further details. Let us say that the quoted price of that stock is 50. The insider tells him, "I will give you calls on 5,000 shares at 45 and 5,000 shares every point up for the entire 50,000 shares. I also will give you a put on 50,000 shares at the market." Now, this is pretty easy money for the broker, if he has a large following, and of course this is precisely the kind of broker the insider seeks. A house with direct wires to branches and connections in various parts of the country can usually get a large following in a deal of that kind. Remember that in any event the broker is playing absolutely safe by reason of the put. If he can get his public to follow, he will be able to dispose of his entire line at a big profit, in addition to his regular commissions. I have in mind the exploits of an insider who is well known in Wall Street. He will call up the head customer's man of a large brokerage house. At times, he goes even further and calls up one of the junior partners of the firm. He will say something like this. Say, "Old man, I want to show you that I appreciate what you have done for me at various times. I am going to give you a chance to make some real money. We are forming a new company to absorb the assets of one of our companies and will take over that stock at a big advance over present quotations. I'm going to send in to you 500 shares of Bantam Shops at $65. The stock is now quoted at 72. The grateful insider tells the thing to a dozen of the headmen in various big brokerage houses. Now, since these recipients of the insider's bounty are in Wall Street, what are they going to do when they get that stock that already shows them a profit? Of course, advise every man and woman they can reach to buy that stock. The kind donor knew this. They will help to create a market in which the kind insider can sell his good things at high prices to the poor public. There are other devices of stock-selling promoters that should be barred. The exchanges should not allow trading in listed stocks that are offered outside to the public on the partial payment plan. To have the price officially quoted gives a sort of sanction to any stock. Moreover, the official evidence of a free market, and at times the difference in prices, is all the inducement needed. Another common selling device that costs the unthinking public many millions of dollars and sends nobody to jail because it is perfectly legal is that of increasing the capital stock exclusively by reason of market exigencies. The process does not really amount to much more than changing the color of the stock certificates. The juggling whereby 2 or 4 or even 10 shares of new stock are given in exchange for one of the old is usually prompted by a desire to make the old merchandise easily vendable. The old price was $1 per pound package and hard to move. At 25 cents for a quarter-pound box, it might go better, and perhaps at 27 or 30 cents. Why does not the public ask why the stock is made easy to buy? It is a case of the Wall Street philanthropist operating again, but the wise trader bewares of the Greeks bearing gifts. It is all the warning needed. The public disregards it and loses millions of dollars annually. The law punishes whoever originates or circulates rumors calculated to affect adversely the credit or business of individuals or corporations, that is, that tend to depress the values of securities by influencing the public to sell. Originally, the chief intention may have been to reduce the danger of panic by punishing anyone who doubted allowed the solvency of banks in times of stress. But of course, it serves also to protect the public against selling stocks below their real value. In other words, the law of the land punishes the disseminator of bearish items of that nature. How is the public protected against the danger of buying stocks above their real value? Who punishes the distributor of unjustified bullish news items? Nobody. And yet, the public loses more money buying stocks on anonymous inside advice when they are too high than it does selling out stocks below their value as a consequence of bearish advice during so-called raids. If a law were passed that would punish bull liars as the law now punishes bear liars, I believe the public would save millions. Naturally, promoters, manipulators, and other beneficiaries of anonymous optimism will tell you that anyone who trades on rumors and unsigned statements has only himself to blame for his losses. One might as well argue that anyone who is silly enough to be a drug addict is not entitled to protection. The stock exchange should help. It is vitally interested in protecting the public against unfair practices. If a man in position to know wishes to make the public accept his statements of fact or even his opinions, let him sign his name. Signing bullish items would not necessarily make them true, but it would make the insiders and directors more careful. The public ought always to keep in mind the elementals of stock trading. When a stock is going up, no elaborate explanation is needed as to why it is going up. It takes continuous buying to make a stock keep on going up. As long as it does so, with only small and natural reactions from time to time, it is a pretty safe proposition to trail along with it. But if after a long steady rise a stock turns and gradually begins to go down, with only occasional small rallies, it is obvious that the line of least resistance has changed from upward to downward. Such being the case, why should anyone ask for explanations? There are probably very good reasons why it should go down, but these reasons are known only to a few people who either keep those reasons to themselves or else actually tell the public that the stock is cheap. The nature of the game as it is played is such that the public should realize that the truth cannot be told by the few who know. Many of the so-called statements attributed to insiders or officials have no basis in fact. Sometimes the insiders are not even asked to make a statement, anonymous or signed. These stories are invented by somebody or other who has a large interest in the market. At a certain stage of an advance in the market price of a security, the big insiders are not averse to getting the help of the professional element to trade in that stock. But while the insider might tell the big plunger the right time to buy, you can bet he will never tell when is the time to sell. That puts the big professional in the same position as the public, only he has to have a market big enough for him to get out on. Then is when you get the most misleading information. Of course, there are certain insiders who cannot be trusted at any stage of the game. As a rule, the men who are the head of big corporations may act in the market upon their inside knowledge, but they don't actually tell lies. They merely say nothing, for they have discovered that there are times when silence is golden. I have said many times, and cannot say it too often, that the experience of years as a stock operator has convinced me that no man can consistently and continuously beat the stock market, though he may make money in individual stocks on certain occasions. No matter how experienced a trader is, the possibility of his making losing plays is always present because speculation cannot be made 100% safe. Wall Street professionals know that acting on inside tips will break a man more quickly than famine, pestilence, crop failures, political readjustments, or what might be called normal accidents. There is no asphalt boulevard to success in Wall Street or anywhere else. Why additionally block traffic? Transcriber's notes. Punctuation and spelling were made consistent when a predominant preference was found in the original book, otherwise they were not changed. Inconsistent hyphenation was not changed. Simple typographical errors were corrected. Unbalanced quotation marks were remedied when the change was obvious and otherwise left unbalanced. The illustration on the title page is the publisher's logo. Page 224. They were afraid of getting stock if they tried to was printed that way. Stock may be a typographic error for stuck. End of project. Gutenberg's Reminiscences of a Stock Operator by Edwin Lefèvre.